Hi, I'm the BTS Trader. Yes, you heard correct, BTS. I am the unknown member of the K-pop group, but I got kicked out because I got too old and fat. Okay, so BTS actually stands for Backtesting Trader. So I know I should probably be called the BT Trader, but it's called SEO. So today we're going to try to answer the question, should you buy the dip? Specifically, we're going to look at SPY. The short answer is probably yes. I mean, have you ever looked at a chart of a SPY over the long run? All it does is go up. But as a BTS trader, we're not going to just take my word for it. We're going to actually look at backtesting data for the last 10 years in the SPY. But before we begin, click like and subscribe to the channel. My goal is to ultimately enter the Robbins World Cup of Trading Championship. I don't even know the name, but basically it's a trading championship, and you need a $10,000 account to enter. So full disclaimer, I am not a trading guru. In fact, as you can tell, I don't even have $10,000 to enter the competition. So please take this video as education and some entertainment. Okay, today we're going to be using multi-charts. I'm not actually endorsing it because I'm just using a trial right now. In fact, I'm not even sure it's really worth the price because there's some good things, but there's definitely some downsides to the app. For one thing, some things just seem to load very slowly, data that is. So anyways, like I said, we're going to use SPY. I'm using TradeStation data. Let's look at how I format this instrument. So SPY, 1 day bars, session template, US stocks, regular trading. We're not going to do pre or aftermarket. Roughly 10 years of backtest on exchange time rather than local time. Okay, so how am I defining buying the dip? Well, let's just, for me, and everyone, I don't think there's a right or wrong opinion on what buying the dip is, but for me, it means that, well, we're saying that we're in a bull trend because we're just buying a dip of a bull trend. So I have a 200 period moving average right here. So I'm saying that we're only going to enter if the close is above the 200-day moving average. And what is the dip? Well, I'm using just simple Bollinger Bands, but I'm kind of giving so this is the only part I guess it would be maybe a disagreement. My rule is also, so A, it's that close above the 200, and B, it's that the close crosses over the lower band. Okay, let's see. I'm just using very standard inputs here. So the length, here's the moving average length. We're using the close as the price. Bollinger Band length is 20. The standard deviations are 2. And then this stands for bars since entry. And I'll show you why I have bars since entry in here. Okay, so I already ran the back test. Save time, I won't sit you through that. So here's the bars since entry. So the exit rule is basically if we bought 100 shares, we're going to exit if how many bars after entry. So -1 basically means we bought on a Monday and then we're selling on a Tuesday session. And so you'll see, so if you buy the dip according to my rules, if you held it till the next day, you have a 54% chance of being profitable, which isn't bad. I mean, it's better than gambling. I mean, if you believe in quote unquote Brownian motion, random walk, I mean, that's like a 4% edge. But you'll notice the trend here, right? So here's from -1, and I did this to basically 200 sessions, 200 days. Let's see if I could get closer. Yeah, okay. So you can see your probability of having a winning trade increases as the longer you hold it, right? For the most part, right? So we're seeing 80 to then we're seeing some 90s over here, and now we're seeing some hundreds. So the hundreds come in around, let's see how many bars, around 96, 93 bars in. So let's say, these are trading days, but let's say three, three-ish months, 3, 4 months, whatever you want to call it, right? And then it has a level of stability right here. See, from 93 to, let's see where the 100, see, then it starts to drop off here, right? Or consistently drops off after 120. So in a way, you can see that's like a 90 to 120 days. I mean, I don't study time cycles at all, but that's interesting. I mean, this is obviously just back testing, so we don't really know how this would actually perform in the future, but it's interesting to see how it's performed over the last 10 years if you quote unquote bought the dip of that's a standard 2 standard deviation dip. And so this is just a net profit curve. So yeah, we could kind of peak at, I mean, it definitely peaks around here around 150, but I mean, you're not really losing much if you're holding around this 60 to 90 period here. I mean, there's a bit of stability right here, roughly, I mean, on average. And then you see another dip, so it's almost like you can see that possibly there is this market cycle of like, okay, every 90-ish, every 3 months, you're going to kind of see these dips. Call it time cycle, call it, I don't know, some kind of rebalancing. I don't know, actually. I really don't. I mean, I'll leave that. I'm sure there's someone who has a better guess on why that is. And then let's see, we could also look at that was net profit. Let's see that versus max drawdown. So yeah, it's also, I don't know, to be honest, I don't really know how to read this chart that well. I mean, in relation to the max drawdown, it's almost easier to look on the table. Because as you can see, the max drawdown is pretty big, right? So it's basically this quote unquote system or this concept is like, can you hold out during these drawdowns? And that's always the big thing about these dips, right? I mean, we know, kind of like as I mentioned at the beginning of the video, we know SPY is going up. I mean, historically, it's going up. I mean, in a weird way, if you're a quote unquote day trader and you see a lot, and if you have margin and whatnot, and if you see you're closing, I mean, you see a red day. I mean, basically, if you, like, let's pretend you're just holding shares. I mean, you just have to hold it, right? I mean, it's only about the psychology that tells you, oh, okay, I'm losing, I got to exit, I'm going to cut my losses. But in reality, if you held it for for a little bit, you're probably going to see a positive net income over there. But is this tradable? Not really, right? Because you have to look at the, let's see, no, let's do total trades over here. So the total trades, so the most that's happening, and actually it goes to show you about buying the dip, like these 2 standard deviation moves. So over 10 years, we have 51 trades, which, that's why you can't really trade this system, because you're basically keeping the system on for like 10 years for 51 trades. It's not very, I'm not sure that's a capital efficient, very capital efficient. So, but the idea, the concept we're getting at is, okay, what if we see like SPY dump with these 2 standard deviation moves? Should you be completely scared of buying that dip? And according to this data, and who knows, maybe I wrote my code wrong, but no, you probably don't have to worry too much. You just have to suffer through maybe a substantial drawdown, especially in March 2020, right? But even March 2020 showed us if you hold, you're going to be relatively okay. Of course, you need if you're not trading shares and you're on margin, then you have to have the margin to be able to meet those drawdowns, right? That's the only thing. I adjusted the test a little bit. So it's basically the same inputs, the same rules, above the 200 moving average, you're buying this dip. Let's go ahead. People like candles, right? People are buying this dip, but here, the one difference in this rule is that we only sell, or I mean, I put it in there. It's actually interesting to see the back test shows the loser, but one of the rules is that we only sell if our position has a profit greater than 0. And that, I call that, that's, you're really holding, you're really diamond handing, as they call it, right? Okay, so here's that test. And you see that you actually, if you basically try to refuse, basically you refuse to sell anything in the red, and you always hold, you're going to be okay. Even, let's see, this is the shortest holding period, is like the average bars until if you buy that initial dip and you buy when it crosses over the lower band, your average bars before you become profitable is around 5 bars. And that'll happen maybe 83% of the time. And that's historical, of course, not saying it'll happen in the future. But it really goes to show you. And then, yeah, if you really say, okay, I'm not going to sell in the red, you'll see that they're, obviously you should be more profit. I mean, in fact, I don't even know, like, according to my trading rules, I mean, maybe someone who knows, so these trading rules are written in something called easy language. And so I'm not an expert at it at all, but so maybe someone could explain why, even if I have an exit saying that do not sell unless I am profitable, why I still have a gross loss. I have no idea. I don't really get the concept, but this still is. But here you can see that in average bars held 25 bars, 25 trading sessions, you can see some 100% historical winners. But you're still seeing these major drawdowns, which I would think is close to the the March 2020 is this drawdown, I would assume, or one of them at least, right? But let's go, well, actually, let's stick with this strategy. Let's look at the actual strategy performance report. So as you can guess, yeah, the biggest drawdown is that March 2020 right here. Let's see. And what is actually, I don't even know what the bar since entry rule is, but I guess since it's 31,000, I think it's because I chose the bar since entry exit input as the highest net profit. So this is using the highest net profit input. And let's see the performance ratio. See, we even have annualized Sharpe ratio 0.4, so these are at least not red. Trade analysis. But yeah, like I said, there's only 21 trades over 10 years, which does go to show you, once again, like I said, it shows you how rare actually those moves below the 2 standard deviation are. Let's see, average trade. Yeah, I would hope so. Let's look at the annual period analysis. So yeah, really like that 2018. I mean, I don't want to make this video too much longer, so I'm not going to go back and see how, even with the rule saying that we do not sell unless we're profitable, how I have a loss here. But so there you have it. If you had bought the dip of the SPY over the last 10 years, according to my rules, you probably would have been okay. Well, actually, you would have been okay according to the back-tested data. Will you be okay in the future? It's hard to say. I mean, as they always like to say, past performance isn't an indicator of future performance or something along those lines. And that is true. I mean, tomorrow we could have, I don't know, the Delta variant could turn into like those monsters from A Quiet Place, and the whole world is, has more problems than a dip in the SPY. An important note is that this test only applies to SPY, and if you did this in individual equities, you're going to probably have different results. So that's it for this video. Stay tuned for the next one.